Well, absolutely. I mean, Janet Yellen, I think yesterday said something about measures of expectations of what drive prices, and they look pretty good. Well, what measures is she talking about? She's talking about the bond market as usual, and the bond market, as we know, there's a big fat thumb in the scales called the central bank. So that is an issue which it's a measure that doesn't measure anything. It measures itself. But yes, if you look at all the business surveys, you look at things like the Philly Fed Index, you look at the NFIB Small Business Survey in the States, and so on and so forth. And not only have most of these businesses raised prices dramatically, which has been shown up then in the official indexes, but they're all planning to raise prices further in the future. And I don't know where we get this idea there are no expectations. They're there in front of you.
So if you connect this up to the markets and the trading we've had, I mean, the bond yield on the 10-year US Treasury yield has declined. Nothing to see here, no concerns sort of category around this 1.3% level versus where we traded in March. And then equity markets, a little bit in a low, but still in between all that, continue to track around fresh records. Is this telling you about a level of complacency or a sell-off coming up down the track?
Well, it's a bit of both, isn't it? It's wishful thinking, it's denialism, it's special pleading, perhaps it's downright deceit. People don't want to open the box and look and see what's inside it. But on the other hand, I mean, the Fed has basically flooded the market with so much liquidity. We've had all this discussion for weeks now about the infamous reverse repos, which got up to nearly $1 trillion and are still running, I think, at $750 billion. People have so much money pumped at them by the Fed that they don't know what to do with it. So is it any surprise that Treasury yields are falling in that circumstance? Now, should they be falling, were this a market that was actually based on people's intentions to save and spend money and to put things aside for the future, which is what a bond market should be doing? Absolutely no. They're at negative interest rates. The spot real yield, subtract today's CPI from today's 10-year yield, and it's back where it was in the Great Inflation, highly negative. German bond yields have not been this low in the post-war era. This is a madness. It's a madness driven by institutional measures, nothing to do with the underlying economics.
Yeah, Sean, just one more bit of madness. We haven't got that much more time, but the leverage argument as well. You put out in your copy that Jerome Powell seems to think businesses are reducing leverage. Every single one of your charts and a lot of other charts I've seen as well said no, quite the opposite. There's a vast amount of leverage out there.
Well, the only thing I can think he's talking about is maybe debt to equity ratios, because if we look at market cap, it's super high because we've inflated the value of stocks. And the stock prices have gone up faster than debt levels on the balance sheet have risen. But if you look at debt to net worth has been flat for many years now in most cases, but debt to operating income is still at all-time highs. It's secular highs. I think in the manufacturing industry, it's between 3.5 and 4 times EBITDA. Now you can't say that's unleveraged.